Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, September 23rd. We're back from an 8-day trip to Boston, New York City, and New Jersey, where we met with lots of clients, had a big dinner the night of the Fed meeting, and lots of fascinating discussions. S&Ps are up about 15 handles right now. The Treasury curve is bear steepening again today, which has been the reaction to the surprising 50 basis point easing, which has gotten investors increasingly concerned about the bond market over time. Interestingly, was something that we thought was probable, that the rates, the 50 basis point cut, which has been our forecast for quite some time, would actually mark the peak in the bond market rally that took place for the last several months. So our note this week was titled Long Policy Lags. We began with a discussion about whether this was going to be a recalibration or the Fed chasing a recession. And the bottom line for us here is if they get to 4% by the January meeting, which is our forecast, we do think they will be cutting 50 again in November. We expect the next two employment reports to be decidedly soft, as has been the case throughout the course of the year, and in particular over the last 3 months or so, 3 to 4 months. We think they'll, they'll be cutting quickly. If they get to 4, we can manage to skirt a recession. That could very well turn out to be the terminal policy rate. We've held for probably 18 months that 4% was a level that would painlessly disinvert the curve, relieve the pressure on small banks and the smaller business sector in general. You can see, if you're watching the video version of this, the picture that's up shows you NFIB earnings trends for small businesses, and they're as weak as they've been any point over the last 40 years, with the exception of the global financial crisis. We've actually had a series of recessions. For those who want to dunk on anyone talking about recession, that was not our forecast in 23, but we think we're perilously close to one now. And in fact, in one for the small business sector. We had an inventory recession in 2022. We had a residential investment housing recession in 2022. We had an earnings recession that began in the fourth quarter of 22 and lasted through mid 23. The earnings outlook, by the way, is not particularly good for the third quarter. And now we've got the labor market threatening a recession as well. So it is a real question whether this will be a recalibration cycle or the Fed chasing a recession. The title of the note, again, Long and Variable Lags. We went in depth into the various channels of the Fed's balance sheet, the liquidity channel, the duration channel, how this was a big benefit to large banks, to large non-financial corporates. It's why we didn't have that broad-based economic slowdown. We've had just this series of hits. Again, if you were a floating rate borrower, policy was tight, the lags were short. If you were a borrower who could borrow out further out the curve, or a beneficiary of unprecedentedly generous or accommodative fiscal policy outside of a wartime or a recession, again, you benefited. And so that made those lags longer. We then delved into, okay, are we going to get a positive business confidence shock here or not? And certainly ahead of an election for small businesses in particular, that's unlikely. We could find ourselves in a much better environment next year, but that is dependent upon the election outcome. We continue to think that a blue wave is a big risk to equities in particular, and likely the overall investment environment. So we then went on to discuss housing and concluded that we think we'll need to get to at least 4% before we begin to see housing supply and demand really respond to lower rates, and provided plenty of evidence about why that would likely be the case, and wound up our note with a discussion about the 3 E's, the election, earnings, and the economy, none of which look particularly sanguine or optimistic in the near term, nor are they sufficiently priced in the equity market. So we're not chasing the Fed rally here. We've had decent cyclical exposure. We think the Fed did the right thing by going 50. We do think, though, they need to get to 4% in very short order. We could find ourselves in a better environment next year for equities, not so much for fixed income. That was one of the consensus views that we surmised from our discussions with our clients, was the bond market could be under significant pressure again next year. So that's it for me this week. If you're not a full subscriber to Ironside's research, if you want to be able to get all these details, we're happy to offer you a trial. Otherwise, we'd love to consider to have you come on board and be part of the Ironside's team, so to speak. Have a good week, everyone. Thank you.